Okay, so now the next question that we were going to talk about is we want to talk about mortgage insurance.
Yes.
And I know you've got a PowerPoint because you are fantastic at doing that. So can you go through mortgage insurance, explain it to us, explain what the options are with that and how that works?
Well, and because a lot of people get confused, with all the terms and with the applications, they're like mortgage insurance and then homeowners insurance, and it's like, what is all this? And so let's just
Dive in there.
let's do it.
Yep. And then one other caveat. A lot of people will spend a year or two building up to get to their 20% down because they're so afraid of that mortgage insurance amount, and it ends up costing them a lot more in appreciation and money being held. So sometimes that's not the best strategy. So hopefully we can just talk about that a little bit as well.
You read my mind, Sean, because that's exactly what I'm going to be talking about. Exactly. Okay, so mortgage insurance versus homeowners insurance. Let's just start talking about it. Homeowners insurance is just insurance like you have a car insurance, right? You need to protect your house in case of fire or some other disaster. Mortgage insurance is insurance that protects lender in case the buyer is in default. And when buyers stop making payments, house goes back to the mortgage to the bank, and it's very costly, so they want to be protected. And when you put less than 20% down, there is a mortgage insurance that is mandatory. On conventional loans, it can be removed once there is 20% equity in the property,
Okay.
or it comes off automatically once there's 22% equity in the house.
Okay.
So yeah, the MI, short for mortgage insurance. And just exactly like you said, people want to save up money to avoid that mortgage insurance, and then they miss out. So let's take a look. I ran some numbers. So again, hypothetical scenario, we have price of 500,000 and somebody's putting 10% down, so they have 50 grand, they're gonna put it down. I ran scenario for 740 credit score. The mortgage insurance on conventional loans works also kind of like a car insurance. When you get car insurance premium, they look at your driving record. The same is here with mortgage insurance, better credit score, lower premium.
Okay.
And better driving record, lower premium on the car insurance, right? So depending on the credit score, depending on the down payment, and depending on actually how many people are going to be on the mortgage, the mortgage insurance payment could be different. So this is the scenario, 10% down, 740 score.
Okay.
1 year to save up. Okay, so that's a little bit backwards, but okay. So MI, one person on a mortgage, monthly payment is $90 per month, or $1,080 a year for the mortgage. If there are two people, it's a little bit cheaper, $71.25 per month, or $855 a year. So somebody says, okay, well, I don't want to pay this. I'm gonna save up additional $50,000 to actually get to 20%, right? So how long is it gonna take for someone to save up 50,000?
Probably, yeah. If they're fortunate and they can put that much money away, but for some people, I mean, for a lot of people, that would take a couple of years. But a year is a good start.
Yeah, so let's say just a year. If probably you're right, couple of years, but let's say it's even 1 year to be very optimistic. They're gonna miss out. They don't want to pay $1,000 a year. They're gonna wait to save up 50,000, and they're gonna miss out on appreciation of about 35,000. So let's say if appreciation is 7%. So in 1 year, the same house is gonna cost 535,000. They actually need to save up more than 50,000 at this point, right? Because 535 is gonna be the price. So
Like
20%
57,000
down
now
is
they
gonna
have
be
to save up.
more. Yeah.
Yeah,
And let's say this is 10% down. Somebody has only 5%. The monthly MI is gonna be higher. So let's look at that scenario with 5% down. So the loan amount 475, probably gonna take them about 2 years, let's say, save
Yeah.
up
Yeah.
75 plus. The mortgage insurance for one person is $142, which is $3,400 a year, or $110 for two people, and it's $2,700. Actually, not for a year, for 2 years, because we're waiting, right, for 2 years to save up the $75,000.
right,
We have missed appreciation of about 70,000,
Wow.
yeah,
if not more than that. So you don't want to pay $3,500 in mortgage insurance, but you're gonna miss out on at least $70,000 in
yeah.
appreciation.
That's like you come into me and saying, hey, I tell you what, I'll make you a deal. So you ask me, you say, give me a check for $70,000. So I give you the check for $70,000, and then you give me a check for $3,420. It's like,
Exactly.
is that a good deal? It's
Yeah,
like, no,
not a
I'm
good
not doing
trade.
that. That's not a good trade at all.
Exactly.
Yeah.
And in some cases, mortgage insurance is tax deductible too. That's another thing to keep in mind.
Okay.
You need to talk to tax advisor, of course, to make sure that in your particular case, it is
Yeah.
tax deductible. But if it is, you're gonna basically pay even less than
Yeah.
142 a month.
Yeah, that's great.
Yeah. Yeah, I think that's a really, really good example. And
Mhm.
that's where emotion versus logic plays in. It's like, and that's the beauty about real estate is
Right.
everything can be based on numbers and logic. So I think this is a great explanation.
I think it is too. And to hit the point again that, all you need, let's say they only put the 10% down, and all they need is the time it takes to build the equity and another 10% while they're in the home. And then they can get the BPO or an appraisal and get that removed. So
Yeah.
it's removable,
Yeah.
it's a temporary thing. So it just really makes no sense to not get into a house now, just because of mortgage insurance.
Yep.
Exactly. And if rates will go down later, they're gonna refinance anyways, and they reach 20% equity at that point.
Yeah. And most people are going to sell a house within 5 to 7 years. So they're only at max, they're going to pay, if they follow the average, they're going to pay 7 years worth of that mortgage insurance. And I mean,
Yeah.
I think the numbers make total sense to not worry about that mortgage insurance.
I
Yeah.
agree.
I didn't realize though that it was different with more
didn't
people
either.
on the mortgage. So
Yeah.
that was cool to know. I didn't know that.
Mhm.
Yeah.
Okay.
It makes-
Yeah. I guess they think that when there are two people, less chance that they're gonna foreclose.
Yeah.
Oh, yeah.
Yeah.
Yeah. Well,
that makes
and I think that as we say pretty much on every, what's my phone ring next?
Nothing.
As we say on pretty much every mortgage minute, the best thing to do is talk to the lender. So they need to talk to you, let you run the numbers and give them the scenario so that they can figure out what their best option is.
Absolutely.
Yeah.
That's true.
Okay. All right. Well, thank you. We really
Yeah.
appreciate it. How can people reach you?
They can call me at any time, 571-245-3000.
Okay.
That's right.
All right. Well, thank you. We will see you on next
Thank
week's Mortgage Minute, and everybody have a great week.
Yep. Bye.
All right.
Have a great week. Bye.